Hi everyone, this is Akshay Madasu, Equity Research Analyst at WealthTrust Capital Services. This is the first episode of a bi-monthly series that we're starting, where we'll be sharing short snippets of our key findings from our research desk. In the first episode, I'll briefly be going over a recent study that we did on what variables or factors really drive equity returns in the longer term. So, how we tried to structure this study is we've essentially taken the entire universe, close to 7,000 stocks, that is, and we've categorized them based on three key variables that we think really determine returns in the longer term, which are ROE, PE, and earnings growth. The reason is we think these three metrics really determine the quality, the valuation at which we are buying, and the earnings growth of businesses. So by mixing up combinations of these three variables, you can get 27 possible combinations, and you try to estimate what is the median return of each combination. Now again, median has been picked because average skews the data. If few names could really spike the data up, so that's why we picked median over average. And these are the key results. So, off the bat, if you really look at it, the conventional wisdom does seem to be true. Buying into a higher business at a lower valuation that goes on to give higher earnings growth has tended to give the largest sort of returns relatively, and that has to be the first key finding. Now, I wanted to focus on median rather than average for the earlier mentioned reasons. The second key finding should broadly be that if you see the first three combination, all of them consist of low P companies. That should tell us is that the price you pay is the most deterministic factor of the subsequent returns that you're likely to make. And another key thing, if you look at it, should be if you really go to see the worst performers, the bottom, I think, bottom 7, 8 combination, all of them consist of low earnings growth companies. So, there really is no substitute for growth by paying, let's say, a lower multiple. You're buying into a business, there has to be earnings growth. That really seems to be, you know, defining the returns you'll make going forward. And we've also sort of plotted this surface plot, a three variable surface plot, a three-dimensional surface plot, which has, ROA on X and P on Y and EPS on Z. So even so we sort of plotted this to visually see and understand rather than going over the table. And even in this, it is very clear, very evident to the eye that you know buying a higher ROA business at lower valuation that goes on to give higher earnings growth tended to give better returns as compared to, let's say, something in the lower ROE cohort at a higher valuation with a lower earnings growth. The thing is, this data is of the past, and markets are obviously evolving and complex, and what works today may not work tomorrow. So, we'd suggest you consult your advisor before taking any financial decisions. Thank you.